Top 7 things you must know when investing with options. Ladies and gentlemen, welcome back to Pandrea Finance. My name is Alex Pandrea, and in this video, we're gonna go through everything that you'll need to know about option investing. Maybe not everything, but we're gonna get you on to a good start. We're going to do it in 7 steps. First, we're gonna start with the basic principles, and then we're gonna add detail and more information with each new step. Now, whether you're a beginner or more experienced connoisseur of investing, please watch until the end, because at the end, I'm gonna share a bonus tip with you, something that I didn't understand for the longest time, but look at me now. Now I do. And now my goal is for you to understand each one of these principles before jumping into any investment. So if you are ready, go ahead, hit the like button before we start, and let's begin. Number 1, an option is a contract. Now, the first thing that you have to understand about options is that an option is simply a contract or agreement between two parties, the buyer and the seller. Now, it's important to note that you're not actually investing in the company itself when buying and selling these option contracts. See, usually when you buy shares in a company, you're invested in that company, you own a piece of that company. But with options, we're buying and selling the contract itself, which controls the shares, but is not actually invested in the underlying stock. Now, buyers and sellers buy and sell these contracts all day long in a mad frenzy, hoping to make a bit of money so they can use it to, feed their children. Now, one of the most important things that you have to keep in mind is that you can always sell the contract before expiration. This is a question that I see brought up often. Hey, Alex, do I have to hold my contract until the expiration date? No. The answer is no. You do not have to hold the contract till expiration. You can buy them and sell them anytime before. So let's just say you just bought a call option and want to sell it 20 seconds later because you chickened out of what could have been the best trade of your life. Well, guess what? You can do that. Go ahead. Look, if you got paper hands, that's nothing to be ashamed about. You know who you are. Number 2, understanding contract characteristics. Now get out your notebooks because this one is an important one. Every option contract has 3 key features or characteristics that differ from if you were just investing in stocks alone. The first thing is that one option contract represents or controls 100 shares in the underlying company we're invested in. So let's take a look at an example. For example, let's pull up your favorite stock. Go ahead to trade options. We're going to click on an expiration date and click on, in this case, we're taking a look at MGM, again, just as an example, and we're going to click the $42 call. Now, if you go ahead and input one option contract into your order, you'll notice that it says buy MGM $42, and underneath it says times 100 shares. Now, why does it say times 100 shares? Well, I just told you, because one option contract represents 100 shares of the underlying stock, in this case, MGM. Another key feature is that every option contract has a strike price. So going back to our example, pull up the option chain and you'll see on the left-hand side of the option chain, you see strike prices. Now these strike prices represent the potential future value of the stock, and investors can make trades based off of whether they think the stock price will move above the strike price or stay below the strike price. And the last key feature is that every contract has an expiration date. Now this simply means that the contract will expire at some point in the future. Now you can find these expiration dates by going to your favorite company, hit trade options, and at the top you'll see the expiration dates. Now the expiration dates range from expiring a few days from now, a few weeks from now, all the way to, if we scroll all the way to the right, a few years from now. Now, the further out you choose your expiration date when making an investment, the safer that investment is going to be, because we are giving our investments time to make money and make profit. Now, you can click this video up here if you want to see how I use expiration dates to my advantage in my investment strategy. Click right there. Thinking about it, I think life itself should have an expiration date. That didn't sound right at all. Obviously it does. It does. What I meant to say is more things in life should have expiration dates. Because if you have deadlines for things, it gets you motivated, right? Gets you pumped up. We could all stop being lazy bastards. Number 3, calls and puts and buying and selling. All options are broken up into calls and puts. And you could either buy them or sell them. That's it. You can buy a call, you can buy a put. You can sell a call, and you can sell a put. Those are the combinations that we have to work with. Now coming down here and taking a look at our beautiful Robinhood app, at the top of the option chain, you'll see buy, sell, and call and put. And you'll notice there's only 4 combinations that you can make. You can buy a call, you can sell a call, you can buy a put, and you can sell a put. If you're trying to do more than that, well, you can't. However, what you can start doing when you're more experienced is start combining these different options. Buying a call and then selling a call, or buying a put and then selling a put, or all those 4 put together. You can start combining all of these into one big mess of a trade, which will get you probably even more confused than you are right now. But for those of you who want to learn, I promise you'll be pleasantly rewarded. So if you've ever heard of things like spreads and strangles and straddles, and my personal favorite, the Iron Condor. What's the name of it? I don't know what to tell you. Sounds like a superhero. Iron Condor to the rescue. Don't worry, the Iron Condor is here to save your investments. All of these are basically just combinations of buying and selling puts and calls. And of course, future videos on this channel will cover all of those spicy details on Iron Condors and butterflies, and these are real names, I'm not making this up. Number 4, option sentiment. Now when you buy a call, this is a bullish sentiment, which means that you are hoping that the stock price will go up. Now if the stock price goes up, that means that your option contract goes further down into the money. And if it goes further down in the option chain, that means it's going to be worth more, as you can see in this example. If we take a look at an option chain and we go further down by scrolling down, you'll notice the prices on the right increase. Now if the stock goes down against you, then that's going to push your option more out of the money. So that means that share price line will fall, and your option price will go higher and higher in the option chain here. And if we scroll up, you'll see that the prices on the right hand side get lower and lower and lower until they're worth only just a few cents, which at the end of the day might not be a bad thing, since I've heard that's all billionaires need to buy a decent meal. Now when you buy puts, you are bearish. This means that you think that the stock will go down. So if you've recently visited your local psychic for whatever reason, I'm not saying that I did, and she tells you the world might end, well, buy puts. Now selling calls and selling puts takes the opposite side of the trades that we just spoke about. When you are selling a call, you are hoping that the stock price does not reach the strike price, either by staying at the same level or going down. And when you are selling a put, again, you are hoping that the stock price does not fall below your strike price. Now, when you sell options, what you are basically hoping for is that that option contract will be worthless or worth less than what you initially sold it for. Now, I plan on making a lot of videos on the art of selling options. So do please subscribe if you haven't already, because there's a lot more content coming. Number 5, premium paid and received. When you buy puts or calls, you are paying a premium. Now this makes sense, right? When you go out and buy something, you gotta pay for it, right? Genius tip there, Alex. Thank you very much. Oh, no problem. I'll be here all week. But just stick with me so it doesn't get confusing. We're going a step at a time here. When you sell an option, you are receiving a premium. Now this is called a credit or credit received. Now it's very important to know that when you sell an option and you receive that credit, that money is received right away into your account. It's yours to do with what you want. But now here's where it gets tricky. See, when you simply buy an option and you want to close the position, well, it's pretty straightforward. You sell the option, right? The opposite of buying. So I buy something, I want to get rid of it, I sell it. Easy. But when we sell an option, you have to keep in mind that when you want to close that position, you have to buy that option back. Again, the opposite of how we opened up the trade. So we buy something, we close it by selling. We sell something, we close it by buying. Now that's important to keep in mind, because remember, we received a credit for selling the option. And if we have to buy it back, we're gonna need some money to do that. Now hopefully when you sell an option, you sell it for a higher price and then you buy it back at a lower price, keeping that difference in the middle, and that is your profit. Ideally, you want that option to expire worthless, as in have zero value when you have to buy it back or close the position. So that way you can sell the option for X amount of dollars, have it be worth $0 at the end, and keep that whole premium. But sometimes things just don't work out in your favor. as I might know from past experience. So you might be in a situation where you have to buy back the option maybe at 50%, so you only keep 50% of the premium, or at 20% or at 70%. And sometimes, if you're unlucky, it might be worth more than what you sold it for, and then you lose money. So all of this is just basic, straightforward economics put to options. You buy something, you want to sell it higher than you bought it for, and if you sell something, in this case options, you want to buy it back lower or hopefully at zero than what you sold it for. Got it? Good. Number 6, covering when selling options. Now, anytime you sell options, you must have collateral to cover your position. Now, let me tell you what I mean by that. The option seller, that's you, as per the definition of selling options, has the obligation to buy or sell stock at a given strike price on or before the expiration date. Keyword there is obligation. So if the trade goes against you when you're selling options, you may be forced to sell your shares or to buy shares. When selling calls, you need shares of the company as collateral, 100 shares for every option contract. And when you're selling puts, you're going to need cash as a collateral for that position. Now, this is often why you'll hear terms like covered calls, because the shares that you own cover your position. So if you have 100 shares of Apple, for example, you can sell one covered call on Apple. Those 100 shares cover that one contract's position, just in case that trade goes against you, which sometimes it does. Those shares will get called away from you. This is why you need the shares to cover your butt. Similarly, you might have heard the term cash secured puts. This is the same thing on the put side. If you sell puts, you're going to need collateral as cash. And if the trade goes against you and you're forced to buy the stock, you're gonna need the cash sitting there on the side as collateral so that you have enough to buy the stock. Now, if you wouldn't have this collateral, then that is bad news, because then you'd be forced to buy 100 shares of the company at the current market price. That would not be a pretty picture. Now, thankfully, Robinhood does not allow you to sell options without collateral, so I guess at least they're doing something right. Number 7, understanding premium pricing. Every option contract has a price. This is called the premium. Now, as we already know, the premium is paid by the buyer and received by the seller. Now, it's important to understand how these premiums are priced and what affects their movements up and down. So here, my friends, is the formula for option premiums. Thank you very much. Alright, I'm just kidding, you don't need this formula, but this next part might just get a little bit confusing, but don't worry if it does. I plan to make future videos in more detail on not only this step, but in everything that we learned during this video, so we can make sure that we understand everything in detail and we could all succeed together. Fair? Okay, so an option premium is based off of a few things. The first thing that we have to know is the premium itself is made of two things: intrinsic value and extrinsic value. Now, the intrinsic value is the actual value of what the option is at expiration. So if it has any value, it's that intrinsic value regardless of any other factor. Now, the extrinsic value is also known as time value. And the reason it's known as time value is because, well, time plays a role in its value. Now, the longer you have till expiration of a contract, the more time value you will have. Therefore, the more valuable the extrinsic value is, which therefore means the whole premium has more value. It's more expensive. See, that's why you see in a lot of cases further out options in time cost more, because it has more intrinsic or time value. Now, for example, if we take a look at, let's say, Apple's call options expiring a few days from now, September 3rd, and we go to the $147 call, you can see that for the $147 call, the premium price is $2.38. Now, that $2.38 is made up of intrinsic and extrinsic value. If we go further out into time, let's say October 1st, about a month away, you'll notice that the same $147 call is now with $4.63. It's more valuable because there's more time in that premium. The intrinsic value stays the same regardless of time. Keep that in mind. Another thing that could affect the premium pricing is volatility, the volatility of a stock. See, if you have a wild, volatile stock that goes up and down like a roller coaster, makes you nauseous sometimes, then that stock's premium will be higher in price. And the reason for that is that there's more chances for a volatile stock to hit that strike price. Therefore, if there's more chances of that occurring, then you'll have to pay a higher premium because you're more likely to succeed in the trade because of the volatility. On the other hand, when you have a less volatile stock, one that just doesn't move at all, and you're like, come on, do something, then it's less likely for that stock to hit that strike price, and therefore the premium will be less expensive. Now, putting all of this together brings me to my bonus tip for today, and that is the break-even price of an option at expiration. Now, this is something that I didn't fully understand for the longest part, even when looking on my little Robinhood app and being like, break-even price, I don't get it. And then when I finally did understand it, it hit me like a bag of bricks. You take your strike price, you add your premium price, and you get the break-even price at expiration. Now, this is very important when I say at expiration, because you can still profit from a trade even though it doesn't hit that break-even price just yet, because that break-even price is only for the expiration date. See, if we reach that expiration date and that price did not get to the break-even price, well, then you'll have no profit, no loss. But you can still profit beforehand, and you can still lose beforehand. Now let's take a look at Tesla as an example. And if we take a look at the $700 call, you'll notice that the break-even price is $795.48. And that's because you take the strike price, $700, and you add the premium price to it, and you get the break-even price, right? Because of math or something.
My math specialist, look at him.
So if Tesla reaches that price by the expiration date, then I'm good to go. And if not, I could just, I don't know, post my losses on Wall Street bets. Now that I'm monetized, I can offset the losses with views. Not a bad idea. Not a bad idea at all. Question of the day. What do you think that the most important thing is when investing with options? Now you can click over here to watch some of my other videos. I suggest watching this one right here, where I talk about the steps that led me to making over $1 million using options. Now, if you found something useful in this video, I would appreciate just a simple little like. Hit that little like button. I heard it does wonders for the YouTube algorithm. Thank you so much for watching. Have a great day, and we'll see you in the next video.